the step up in basis, why it may be the most powerful income tax tool in your estate plan. This video is for educational purposes only and does not constitute tax or legal advice. When most people think about estate planning, they think about who gets what. They think about wills and trusts and beneficiary designations. They think about keeping assets out of probate and protecting their family from conflict. What they don't think about is income tax. That's a mistake, because one of the most powerful tax benefits in the entire federal tax code is embedded in your estate plan, whether you know it's there or not. And if you're not planning around it intentionally, you may be giving away a benefit worth tens of thousands of dollars or more. It's called the step up in basis. And once you understand how it works, you'll never look at inherited assets the same way again. It was once said, death is the best income tax planning, but it comes with a high cost. Let's start with the basics. When you buy an asset, a stock, a piece of real estate, a business interest, the price you pay is called your cost basis. When you eventually sell that asset, the government taxes you on the gain, which is the difference between what you receive and your basis. So if you bought a stock for $10,000 and sold it for $60,000, you have a $50,000 gain. That gain is subject to capital gains tax. At the federal level, depending on your income, that rate can be as high as 20% for long-term capital gains, plus the net investment income tax. And Florida residents are spared a state income tax, which is one reason Florida is such a favorable state for this kind of planning. Now here's where the step up in basis comes in. When you die and leave an asset to a beneficiary, something extraordinary happens. The beneficiary's basis in the asset is not what you originally paid. It's the fair market value of the asset on the date of your death. The gain you accumulated over your entire lifetime. Gone. Wiped out. Not deferred. Eliminated. If that stock you bought for $10,000 is worth $200,000 when you die, your beneficiary inherits with a basis of $200,000. They could turn around and sell it the next day with no income tax except for any post-death appreciation. That is an extraordinary benefit. Unfortunately, not all assets receive a basis step-up. For example, retirement plans or an annuity. Now, let's talk about what this means for real planning decisions. A common mistake is where someone has a highly appreciated asset, maybe real estate they've held for 30 years, or a stock position they've built up over decades, and they decide to give it to their children during their lifetime. They think they're being generous. They think they're simplifying their estate. What they're actually doing is transferring their low basis along with the asset. If you give your child stock that you bought for $10,000 and it's now worth $200,000, your child takes your basis. When they sell, they pay capital gains tax on $190,000 of gain. Had you simply held that asset until death and let your child inherit it, that gain disappears entirely. This is one of the most expensive planning mistakes families make, and it's completely avoidable. There's a related concept we're understanding, and it cuts in the opposite direction. It's called the carryover basis rule, and it applies to gifts made during your lifetime. When you give an appreciated asset as a gift, the recipient takes your original basis, your cost. That's the carryover. But when an appreciated asset passes through your estate at death, the basis steps up to fair market value. That's the step up. The contrast between those two outcomes is dramatic. It's why lifetime gifting strategies and estate tax planning have to be coordinated carefully. Reducing your taxable estate by gifting assets is sometimes the right move, but not if you're giving away low basis assets that your family could have inherited tax-free. Now, there's an important limitation to understand, and this is an area where a lot of well-intentioned planning goes wrong. The step-up in basis applies only to assets included in your taxable estate. If an asset is not part of your gross estate for federal estate tax purposes, it does not receive a step-up in basis when you die. That rule sounds straightforward, but its application has created significant confusion, particularly around a popular planning structure called the Grantor Trust. Here's what you need to know. For decades, planners used irrevocable Grantor trusts as a sophisticated tool to accomplish two things at once. By making a trust a Grantor trust for income tax purposes, the person who created the trust, the grantor, continues to pay income tax on the trust's earnings during their lifetime. That's actually a feature, not a bug. It allows the trust assets to grow without being eroded by income taxes, and those tax payments are essentially additional tax-free gifts to the trust beneficiaries. At the same time, the assets in the trust are structured to be excluded from the grantor's taxable estate, which reduces potential estate tax exposure. For years, many planners believed, or at least hoped, that because the grantor was treated as the owner of the trust for income tax purposes, the assets might receive a step up in basis at the grantor's death. The logic had a certain intuitive appeal. If you're treated as the owner for income taxes, shouldn't you get the owner's benefit at death? The Internal Revenue Service answered that question in Revenue Ruling 2023-2. The position of the government is there is no basis step-up at death for an irrevocable grantor trust. An asset held in an irrevocable grantor trust that is excluded from the grantor's gross estate does not receive a step-up in basis at the grantor's death. Grantor trust status is an income tax concept. It does not change the estate tax analysis. And because the asset is not included in the gross estate, the basis does not adjust, regardless of how long the grantor paid income taxes on that trust's earnings. This ruling confirmed what many practitioners had long suspected, but had not been forced to confront directly. And it has significant consequences for any family that has transferred appreciated assets into a grantor trust with the expectation, explicit or assumed, that those assets would eventually receive a stepped-up basis. This creates a genuine tension in planning for large estates. On one hand, you may want to remove appreciated assets from your estate to reduce estate taxes. On the other hand, removing those assets means forfeiting the step-up and potentially passing a substantial capital gains tax liability onto your beneficiaries. For clients who are close to but not clearly above the federal estate tax exemption, this analysis is especially important. The income tax cost of losing the step-up can sometimes outweigh the estate tax savings. That calculation must be done deliberately with real numbers for each taxpayer's specific circumstances. There are planning strategies designed to navigate this tension. One involves structuring a trust with what's called a general power of appointment, a carefully drafted provision that intentionally pulls the asset back into the taxable estate at death for basis purposes, without undermining the trust's other objectives. Another involves the ability to swap assets in and out of a grantor trust, substituting a low basis asset held in the trust for a higher basis asset held personally. So the low basis asset ends up in your estate and receives the step up at death. These are advanced strategies. They require careful drafting and close coordination with your tax advisor. But they exist precisely because the step up in basis is worth preserving. And after Revenue Ruling 2023-2, the planning community has had to revisit how these structures are designed and implemented. Here is the bottom line. Every appreciated asset in your estate has embedded gain. That gain represents a potential tax liability for whoever inherits it. The step up in basis is the federal tax code's mechanism for wiping out that liability at death, but only if the asset is included in your gross estate when you die, and only if your plan is structured to take advantage of it. Revenue Ruling 2023-2 closed a door that some planners had left open. The rules are clear now, and planning around them requires understanding exactly which assets will and will not receive a stepped-up basis, and making deliberate choices about how your estate is structured in light of that reality. Decisions you make today about what to give away, what to hold, how to structure your trusts, and how to title your assets will determine whether your family keeps that benefit or loses it. For families with significant appreciated property, the step up in basis can be worth more than any other single element of their estate plan. That's not an exaggeration. It's a number you can actually calculate. Please subscribe, hit the like and notification button. Until next time.